You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back. It is Wednesday, Education Wednesday, as it's called around these parts. Time for a little show the cool kids call OBC. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the land of the pro. Man, if you're not on the pro side, you missed out on a one-of-a-kind event yesterday. We had a volatility death match for the ages. What does that mean? We had none other than our good buddy, Mr. Dr. Vix, squaring off in a no-holds-barred battle to the death. There can be only one against Mr. Vixologist there. It was a slugfest for the ages. Our pro members got to listen live. They got to ask questions. At the end of the day, they were the arbiters, the judges of who won. I won't say the outcome. You got to check it out for yourselves if you want to hear who won. Two men entered, only one could emerge victorious. The results were shocking, surprising, amazing. Just a good time was had by all, except for the loser. He went home in shame. So if you want to check that out, yet another reason you should be hanging out on the pro, theoptionsinsider.com/pro. And I do know one of the participants in that volatility death match was a little bit addled because they made a comment going into it that my cohort here, the black-hatted one himself, Mr. Dan Passarelli, he was invoked, and they called him a nice guy. And I was like, have you not met the black-hatted one? We call him the black-hatted one for a reason. Mr. Dan, what do you say being called a nice guy on other programs on my network, sir?
I resemble that remark.
I don't know. I don't know what to do with that person. That Dr. Vic seems to be laboring under the assumption that you are a good person. So I think we need to bring him onto this show so we can expose him to the true black-hatted one. What do you say?
We go road tripping together.
That's what he told me. He said you went road tripping. And I was like, oh, did he share his day drinking bottle with you, or did he hoard it all for himself? Did he unzip the cap from the paper bag and offer you a sip? Or did he just keep it in his pocket the whole time, listeners? But you know what? We're not keeping it in our pocket, listeners. It's some fun terminology. Let's get to it now. A little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to the options drills. We're going to dig deep a little bit today. We're going to go into the misty fog of the options world and try to pull out some options terms that maybe have fallen by the wayside a little bit. Delve into some forgotten, some lesser known, some unheralded options terminologies. Maybe some other ones that we've kind of bandied about here on the show over the years that you folks have said, what does that mean? What are you talking about there? So, Dan, are you ready to go on a journey, an odyssey into the dangerous world of forgotten options terminology, sir?
Yeah, this sounds kind of fun.
Before I dive into it, is there one that leaps to mind to you? You say, this is the term that maybe people don't use that much, but maybe should, or maybe we haven't talked about in the show in a long time. Anything that leaps to mind for you, sir?
Yeah, there's one that I just thought of today and mentioned it in a webinar that I did.
Oh, very timely. What was it, sir?
A horizontal spread.
Oh, yeah. You don't really hear that too often.
Yeah.
You want to define it for our folks then, since we are demystifying forgotten options terms, sir?
Yes, it's it's pretty funny. I call it an antiquated, old-fashioned way of saying time spread or calendar spread. That is a horizontal spread. And I said that once in front of John Kamisic, who's our head coach here. And he's like, wait, I say that all the time. I was like, oh, whoopsie.
Really? I was just going to say, I don't recall. I don't know if I've ever heard anyone actually say because obviously it is, you're right, a calendar spread, a time spread. That is the most common nomenclature. I'm trying to think even back on, the early days on the trading floor, and I was hanging out with some of the old timers. I don't think anyone ever said, they said horizontal spread, I would have looked at them and said, horizontal spread. Especially on the trading floor, that could have other connotations that are probably less savory there as opposed to what you're talking about. So I'm surprised your cohort, he must be old school. Horizontal spread. Wow. I don't think I've ever heard that in actual use. So there we go. It's a heavily forgotten term just to kick it off, listeners. Interesting stuff. All right, let's get into some more of the mists, the sands of time and options terminology. Let's get into one, Dan, that isn't that used that often in the retail world, but we used to use it a lot on the trading floor, and we say it a lot. We're not going to say a lot. Once in a while here on the show, and people are sometimes write in and say, well, what do you mean by that? So let's get into that, Dan. Let's talk about legging into a trade. What are we talking about, listeners? This is effectively putting on a trade a piece at a time. Let's say you're looking at a traditional non-horizontal, because only a madman would say that, but a vertical spread. You're legging into a vertical spread. So let's say you buy an at-the-money call first, and then you sit on it for a little bit, and then you wait. Maybe you want to let the stock run a little bit before you sell the out-of-the-money call against it. So you're doing a trade a piece at a time, a leg at a time. It's not common for, I think, an obvious reason. Once you hear that, you could see what the drawback is to this immediately, is that you're taking a lot of delta risk on this trade when you're doing one leg, one piece of a trade at a time, a trade that's designed to be set up as a spread. If you're letting it run, you're kind of just rolling the bones. So there are very few reasons to really leg into a trade, unless you're doing some sort of momentum-based strategy, in which case maybe you want to do a little bit of a nibble first and let the trade run, and then you put on the next leg. But really, even then, it's a highly risky proposition. Dan, what are your thoughts about legging into trades? Do you ever do it?
Yeah, actually, I do it all the time, and I talk about it all the time. I would not say this is forgotten at all. This is our first fight here on the show. We're going to fight. This is definitely, I talk about it all the time. Our students do it. I do it.
So what is your typical use case when you leg into a trade?
Well, here's an interesting one. I've probably done it since then, but remember it's probably about 2 months ago, we had a guy on the show who talked about a long-term buy right in Intel.
Yes.
Yeah. So I actually put that buy right on. And as Intel went down, shortly after that, I legged into basically a split time covered strangle where I sold, like as part of that original spread, I sold the December 25 calls in Intel, but I sold the September 15 puts in Intel after that. So just legged into, I would call it a a split time covered strangle, but I imagine we can come up with some other names for it too.
I don't know if that's really legging. That's more like adding on. Like you did a trade initially at the outset, and then the trade kind of evolved over time, and you decided to add a component. Like you didn't set out to do a split time covered strangle in Intel, right? It just kind of worked out that way. This is the thing I'm thinking about is like you want to do a vertical, but you're not going to do the second leg. You're going to let it run for a little bit, or maybe something even more risky. You know, you're going to do a synthetic, but you only do one half of it and you let the other side run. Something crazy where you want to do one thing, but you're not willing to do it all at once. That's what I'm thinking of. But for your use case, more of an adjustment type thing, maybe a little bit of a momentum type trade. Let us know, listeners. Do you leg into trades on a regular basis? Do you agree with Dan that this is not a forgotten term? I mean, we use it on the show a lot. It's just a lot of our audience doesn't tend to use it or really trade this way. But maybe you agree with Dan. You agree with the day drinking black-hatted one. Hit us up. Let us know as we keep going. Another term that's kind of forgotten, Dan, is volatility smile. Now, you might hear that and think, well, volatility skew, what are you talking about? That's not forgotten. And you're right. Volatility skew is not. Volatility skew, we talk about that all the time. What is and what tends to be more forgotten is the volatility smile. And what that is, listeners, is effectively the shape that everyone thought options were priced in and traded in before 1987. If you looked at a graph of quote-unquote skew, a vol graph back then, listeners, it had a bid to the calls and a bid to the puts, and the at the money was the nadir of the graph. So it looked like a smile. Both ends went up. Now, obviously, you could still have that. We still see that sometimes in, let's say, commodity options or other things like that. Maybe you're heading into a big crop report or something like that, and there's really uncertainty about what might happen, so there's a premium in both directions. We do still see this pop up every now and then, but for the most part, it has been replaced by the term we all use a lot here on the show, which is volatility skew. And for the lion's share of what you folks are trading on the equity side, that means a bid to the puts and a discount to the calls. Mr. Dan, what are your thoughts about volatility smile? Is that a forgotten term we don't really bandy about that much anymore?
Well, I think it's a little forgotten, but I'm going to tell you what, man, I do talk about this one in class, in our classes as well, including and especially in our earnings class, where there's a setting in Thinkorswim where there's 3 different ways that you can set the implied volatility in the options chain. And if you set it wrong, it's kind of hard to do. So yeah, I don't know. I mean, I don't talk about this one all the time. I guess I forget about it on a day-to-day basis, but at least quarterly, I talk about it in classes.
So your cohort uses vertical, or should I say horizontal spreads. You talk about lagging all the time, and you talk about vol smiles all the time. What's going on? What's going on in the MTM chat? I got to check in over there. You guys are throwing around some arcane terms on a regular basis. If you want to get your old school taste of options terminologies, good stuff over there in MTM. All right, this next one, I want to get to one thing, but I think in order to get there, we have to throw down some other terms that maybe are less forgotten. For example, implied vol. You all know what that is. Hopefully you do if you're listening to this show. So I wouldn't really qualify that as a forgotten term, but we kind of have to use this to get where we're going, listeners. Implied vol, of course, effectively what the market's best guess of future vol is. It's what's being implied, the vol level that is implied from the pricing model. You have an options price, and that price implies a certain level of volatility, hence the term. It's a future prediction. Now, looking back, these two terms are interchangeable and a little bit less heralded, especially the realized one. People don't call it realized that often. They often call it historical, but the terms realized and historical are effectively interchangeable when it comes to volatility. Listen, this is, of course, the amount of vol that actually has been exhibited in the past. You can look at it, you can graph it, you can quantify it. You could see on this day, this asset exhibited X% volatility, and that is your realized or historical volatility. Something to remember, those two terms effectively interchangeable, effectively the same thing, which leads us, if you have realized or historical versus implied, what does that get you? Another bit of terminology that is less heralded these days. You used to see a lot of old school guys. I know when Don Schlesinger was on our Vol View show with us, he was always talking about harvesting the risk premium. Probably because he likes to sell an option or two. And what is that? What is that risk premium? Well, it's really just the difference between the two, listeners. It's the difference between the implied volatility level, which is a guess. It's the market's best guess. It's also forward looking, so it has to build in a little bit of a fudge factor. So guess what? Implied 9 times out of 10 is going to be above the realized or the historical vol. When it's not, when realized is above implied, that's when you know things are getting wild. Look at some assets back on April 8th if you want to see what I'm talking about, listeners. Realized vol is getting a little wild in that time frame. So that's when you know maybe it's take your ball and go home time, or it's time to make some real money, whichever you're more comfortable doing. But Dan, the notion of implied vol and historical / realized being a little bit less heralded, especially realized, and then all of that lumped together into a term we don't hear that much anymore, which is the harvesting of the old risk premium, sir.
I got to tell you, Mark.
You say this 47 times a day.
I am writing a book on covered calls and cash secured puts, and I have been talking about the risk premium quite a bit lately.
Is Don Schlesinger your co-author, sir?
No, I wish he was. He's a cool guy. But yeah, I talk about the risk premium, and even you were talking about historical volatility. A lot of people don't say realized volatility, but I make it a point to specifically call it realized volatility sometimes for just because sometimes I'll talk about the future historical volatility, which just sounds weird. So I'll say future realized volatility. So yeah, I don't know. We've got a couple of mind map things going on here that are clashing our worlds together, Mark.
If ever there was a clear sign of his day drinking problem, this is it, listeners. I just can't believe what I'm hearing out here. But Dan, you actually put in something here into our discussion, which I was thinking about adding as well. You added the term back spread. I'll amend and put the front spread on that too, because to me, these are both kind of archaic terms. You hear them every now and then. I don't like to use them. I think they're confusing. I like the old school ratio spread, especially if I'm explaining to someone exactly what's going on. Because you say back spread, they're like, what the hell is that? You say front spread, their response is inevitably, what the hell is that? And then you have to explain to them, well, it's really a ratio, and you're going long units or you're going to short units, depending on the type of spread it is. I think ratio implies a lot more clarity into what the hell you're actually talking about. And you can maybe say reverse ratio. Maybe that's a little bit more confusing, but I tend to use those. But Dan, I agree with you. These are lesser known, lesser used terms, hopefully for a reason. Hopefully they're dying out. I've discussed, even with our good buddy, the late, great Viceroy himself, Mr. Alex Jacobson. I discussed this with him and other people whose history and options stretches back into the primordial ooze days far longer than mine. Our good buddy Don Schlesinger. I've asked a lot of people who were around in those days, where the hell do these terms come from? And I've gotten 50 different answers. No one can agree on what the genesis of the term back spread and front spread even are. It's one of these weird ones, kind of lost to the mists of time. But hey, I guess that makes them perfect for a show like this. Dan, walk us through the back spread and its evil twin, the black-hatted Dan Passarelli version, the front spread, sir.
Yeah, so back spread, I know the etymology of these terms. So
all right, hit us.
A back spread.
You do this trade and you run out the back door of the exchange before anything can hit you, right?
Right. Back spread, like a call back spread, is when you sell a call and then you buy 2 or 3 or 4 or whatever higher strike calls. So it's a ratio. And that's sort of the classic textbook definition. But a lot of the old school floor traders would basically say any positive gamma position is a back spread. And the reason why they call it a back spread is because if you're going to do it the textbook classic way, where you sell it in the money and you buy 2 or 3 or whatever out of the monies, they tend to, the prices line up a lot better and they tend to work better with longer term expiration options, options that trade with the back volatilities, back month volatility. Geez, there's one we can throw on our list too. Back month. Who says that anymore? I mean, I'll say back, but that's why, because they would typically trade in the back volatilities, whereas front spreads are the opposite. You might buy in the money call and sell 2 out of the money calls. And those tend to work better in the front expirations, the shorter terms, because you're selling probably closer to the money, so probably higher theta.
You know what, Dan? I think this is a debate that can only be solved and settled by our audience. So let's put this out to a flash poll. We'll see what our live audience has to say in a few minutes out there. But I agree with you. That one is kind of an older term. And I'm happy to see that one go, Dan. I'm happy to kick that one to the curb. Let's keep going, because we got a lot of... I think we could do many episodes on this, Dan. You got another one here that's kind of interesting. The term under. When we used to price up spreads on the trading floor, the broker would come in. This would especially come into play when you're talking time spreads or diagonals, where you could have 2 roughly equivalent priced options. So you have to kind of know how you're keying the spread. So you have to figure out effectively which one's under, and the other side of that is which one is over. So you'd have to clarify that with the broker ahead of time, so you knew and they knew exactly how you were pricing this up. Oh, I'm doing this June SEP 2035 diagonal 1x2 and the June is over kind of thing. So Dan, walk us through this. This is your suggestion, under, and the flip side of that, which is over, sir.
Yeah, they were always really tricky, because you didn't want to goof it up and end up doing the wrong thing and have 2 people think they were doing the same thing. And so they tend to come into play when it's a more complex trade. I mean, Mark described it exactly, but when you're buying this one and selling this one, and they're different strikes and different expirations, and it might even be a ratio, and you say, and the price turns out to be pretty close to 0 to even. And if the broker wants to do it at a half, like, 50 cents, well, hold on a second. Am I buying the June and selling the September, or am I buying the September and selling the June? So which one is that 50 cents over 0 or under 0? And so you always had to really clarify. And even if I remember, even if the broker would say, okay, I'll do it 50 cents under. Hold on a second, Mr. Broker, which one is under? And you never wanted to tip your hand either. You would hope the broker would goof it up and tip their hand and be like,
you want them to tell you, because that's A, easier, and B, that way you're on the same page.
Yes.
If you price it up backwards and the guy says done, and you're like, wait a minute, I think I'm buying September and selling June, and it's too late. You already did whatever size. You already said done. That's a dangerous scenario out there. Yeah, not one that a lot of our, I think, retail listeners are going to encounter. I don't think a lot of the brokers online are going to ask them, what do you mean is over in that spread? You're going to have to determine that on your own. But that certainly qualifies, Dan, as a forgotten term out there, which is probably has to do with another one of our forgotten terms, going the way of the dodo. That term, going the way of the dodo, has led to things like under and over going the way of the dodo. What am I talking about, listeners? I'm talking about an old school term that, actually, Dan, as I say this, I was talking to the MIAX guys down at OIC. They're rolling out a new trading floor in Miami. So maybe the days of this term are making a comeback. What am I talking about? The locals. The locals, and as a relation, the notion of a trading crowd. I think most people know what a trading crowd is, and that term might still get thrown around. But local, Dan, you don't hear that anymore. They were telling me that old school market makers are hitting them up saying, Miami, huh? Maybe I'll come back down and fire up my old trading badge again. So we might be living, Dan, in the renaissance of the local. What are we talking about?
Yeah. So I remember when I was in college taking my options and futures class, they would talk about the trading pits. And I would go to, and my first job out of college was on the floor of the Chicago Board of Trade. And I was a runner, which was just some, dumb kid that you'd, smack him on the head and give him a piece of paper and say, go give this to, Fred. Who's Fred?
That's
He's
another
one of the
forgotten
locals.
term, runner. There's no runners really anymore unless you count the distance it takes the bits to get somewhere these days.
Yeah, exactly. Right. And like, who's Fred? Well, he's the local who's wearing an orange jacket. It's like, local? What's a local? And a local was just a guy. And that one, I mean, from my experience, I think of a local more on the commodities exchanges. Personally, but I don't know, when I'm done here, it'll be interesting to hear what you come back with, Mark. But he's just like a market maker in either the futures pits or the futures options pits. Typically, I would say the futures pits, and then on the equity options like the CBOE, the people in those pits, they would be called the trading crowd. First time I heard somebody say that, I'm like, the Ford crowd. What's the Ford crowd? It's all the dudes who are standing down in the Ford Motor Company pit.
Yeah, we used to use locals a lot on the CBO, so it wasn't exclusive to, let's say, the CME or the Board of Trade. But I can kind of get what you're putting down there. To me, locals was kind of collectively everybody in the crowd. But to me, it really applied to, let's say, the lone guys down there, the guys down there who are on their own, maybe backing themselves or have a small amount of capital. They're out there doing 10 lots and 20 lots and hitting 1 lots in the book and kind of out there doing their own thing. It probably has its origins. He probably didn't live that far away from the pit back in the day, and they would just commute in locally. And then, by the time we got down there, a lot of people like myself were coming from all over the country to do this. This was a vocation people sought out, as opposed to, hey, it's Charlie from down the street, and let's give him a job as our runner, then make him a local kind of thing. But I can see that being on the future side as well. And that's why I say with this MIAX thing and these new trading crowds, maybe the notion of independent sole market makers could come back. We could have a resurgence of the locals. I might go down to check out the opening of this trading floor, Dan. So maybe we'll see. Maybe I'll get in there and sling a few 10 lots and 100 lots for old time's sake. What do you think?
Man, I'll tell you, that would be fun. Those, I don't want to sound like one of those, those were the days, but we had a lot of freaking fun.
Then I get picked off on 100 lot of some 100 delta nonsense, and it runs against me for 5 points. Like, you know what? This is why I stopped doing this. This sucks. So, it would be probably a little bit of column A, a little bit of column B. Along those lines, listeners, another term. Man, this is turning out to be fun, Dan. Let's go out to another term that has its origins in the halcyon days of floor trading. You don't hear it that much anymore, probably, Dan, because every trade right now goes up in nanoseconds, and there really isn't time for the confusion that there used to be. There really isn't the manual entry that there used to be. You don't have to sit there and write up a trade ticket anymore, Dan. When you used to do that, then you could have what's referred to as an out trade. Broker Joe comes in the pit and says, hey, I sold you 100 of these calls at $5, and you write down 10. Guess what? The next day, and that's how crazy it was, Dan. It was a full 24 hours later. Can you imagine now being hung on 90 contracts worth of deltas for 24 hours and not knowing and not figuring it out till the next morning? Like, oh yeah, I'm good for it. Or nah, busted. It was all wrong or something like that. It sounds ridiculously antiquated now, Dan, in an era where all trades are executed instantly. To have the notion of an out trade existing is antiquated, let alone taking a full 24 hours to rectify it, Dan. What do you think?
Yeah. I mean, it's crazy, right? In out trade where the broker, we would have those in the trading pits all the time. The broker thought he bought these contracts and you thought you bought them, instead of one of you sold. It's like, it went the way of, I have to balance my checkbook too. Like I used to balance my checkbook once a month. Now
you don't balance your checkbook every month. What kind of a savage are you, sir?
I know.
You just hit your bank page and it's all there for you. You know what? Who needs to balance? And who needs to look at an out trade? That was one of my first jobs. When you're clerking, they used to relish sending you in, doing the out trades. It was also a big thing on Saturdays, Dan, like crazy early in the morning. All the new clerks had to go down to the trading floor and meet with the clerks from the clearinghouse whose job it was to do this. And you had to go through your list of out trades. How wild is that? And then say, oh, wait, this is wrong. I don't know this 100 lot, or I do know that 50 lot, or whatever the case may be. Yeah, it all seems so I used to hate it. Dragging in on a Saturday, 6 o'clock in the morning, whatever. It was dark. It felt wrong, Dan. And I'm happy to say it's gone now. So we don't have to worry about doing that anymore, Dan.
And you know what? Like you actually just mentioned one, which it's kind of hard to throw on our list here, but I don't know that trade.
Yeah. Yeah, that was the terminology. Yeah. When's
the last time you said that besides today?
Good luck trying that with your broker today. You buy a 10 lot of some calls on, let's say, Schwab, and then you go back and say, I don't know that trade. Let's bust that. I did. It goes against you. I don't know that one. They'll be like, sir, you have been debited already. That trade is done. But yeah, that was the terminology you would use, listeners, when a trade's hitting your sheets. Someone's coming into you for a trade, a 10 lot, 100 lot, 1,000 lot, whatever the case may be, of XYZ calls. You can look at this and say, I don't know this, as in, I didn't do this trade. You meant to card it up and send it to somebody else, and you mistakenly routed it to me, and therefore I don't know it. Sometimes they might insist, yes, you do, in which case you have a bit of a standoff, and you got to figure out what to do. Maybe you split it down the middle, you take half, or you do something else like that. But yeah, Dan, those were the good times. And you say, I don't know this, and then somebody gets heated because they insist that you do, Dan.
Yeah. And you snuck another one in there, probably without even thinking about it.
It's getting dangerous, Dan.
Hit my sheets. It hit my sheets.
Yeah, all right. Well, define that one for the kiddies, sir.
So, back in the day, you make a trade, and the next morning you get your sheets or your well, I don't know if you were a first stop guy, but your plots.
I was when I started. Yeah.
Yeah. So you would get literally a printout of, sheets of paper, and that would be your positions and such.
Yeah, the notion, another thing, how crazy is that to wait, a full 12 or 24 hours to get a printout of your positions that you could then go through and look at and be like, oh, yeah, I don't know this, or I do. Yeah, everything obviously is instantaneous now, so that also seems antiquated. Also, you mentioned the key term, Dan. You put it here. Now, this one, maybe I will push back on you on a little bit, because we use this one all the time on the network. So our listeners hear this all the time. What are we talking about? The term paper. Dan just used it as paper for the sheets, the literal paper that you hold in your hands. And that is, of course, the origins of this term. Our listeners will know what this means, though. Paper is now, still to this day, synonymous with customers. So when we talk about a lot of our unusual activity listeners, that's probably where you've heard this term. If I'm doing, the odd block with the Flowmaster on Thursdays, or we're doing our options oddities program on the pro side, we're talking about a lot of unusual activity. And we'll say, hey, paper sold 10,000 of this, or paper bought that. It is kind of an antiquated term, though, because, obviously there's nothing going up on paper anymore, Dan. But this is one of the few ones on this list. Like, I can't remember the last time I said local, and I try to resist saying back spread and front spread whenever possible. Or I can't remember the last time I said over and under on a trade, but I say paper probably multiple times a week, sir. But I'm a unique use case.
Yeah, I mean, I do throw that one out there every now and then. And yeah, I mean, honestly, probably about the same amount I talk about the volatility smile or sneer for that matter. But you don't hear it too often.
Here's a good one that you never hear anymore, Dan. And I'm glad you added this one to the list as well. Cabinet. When's the last time? Think about it. When's the last time you traded anything for a cabinet, Dan?
Well, it's
just yesterday, as you pointed out. I traded 10,000 Intel calls for a cabinet.
Well, I mean, so we got so actually I just thought of another one that goes along with this, because I mean, actually kind of technically I do trade cabinets maybe once a week or so. So let's talk about this. So it used to be back in the day, we traded in fractions. Stocks were in eighths. Options were in sixteenths, which were also called teenies or stinks. which we can throw on the list for sure. Teenies or steenths, which was a 16th of a dollar is $6.25. But what if you wanted to trade it for less than a teeny? What if you wanted to trade for less than $6.25? Well, you could, and that was called a cabinet trade or a cab. And you would say, okay, I'll buy those for a cab, which was $1, or you could say cab 2 or cab 3, which is $2 or $3 respectively. So now, I mean, kind of, if you think about it, technically, since you trade in pennies.
Yeah, when you buy things back for a penny, technically it is. You're correct. But
yeah.
I've not called it that. But you're right. It was kind of penny pricing before it existed. It was usually done, listeners. You're getting close to expiration, probably on expiration day. You got a boatload of something sitting in the book that they want to clear out, and nobody wants it for 0.0625 cents, Dan. But, I'll take it for a cabinet, which means I'll take it for a penny, right? I'll take it off the books for a penny, and I'll do something with it. Or maybe you'll come around and sell it for a penny. I remember that happened one time when I was out in Intel. There was a boatload of stuff sitting on the book, like straight out of the money calls, and sizable, like at least 1,000. And they were sitting there all day because no one wanted to sell these things because it was not that far out of the money. It wasn't an earnings day, but it was expiration day. You never knew what could happen in the after hours. And then I'm doing something in my sheet. I look back up, and that size in the book is gone. And I turn around to this old timer who's standing next to me, and he's standing right next to me with a huge grin on his face, and he has the ticket he held up in my face with like the 1,000 lot or whatever that he had just sold for a penny.
Oh.
And I was like, okay, that's cool, $1,000 or whatever. But it's like, you have kids in college. What if Intel in the after hours, right after we close, something happens? They go crazy, they buy something, whatever, and the stock spirals up a couple of hands. You're not only out of your job, your house is gone, your bank, you're on the street for this 1,000 lot. You're gonna do that? But he was giddy. He was giddy that he got $1,000. And I was like, well, okay, $1,000 is cool. I'm not gonna get mad at that, but risking everything for that, it was such an insane thing to me. So that always, when I think of cabinets, Dan, I still remember that guy's acronym. I won't say it out loud. Maybe he's listening. Probably dead. But knowing the lifestyle those guys lived, it didn't lead to longevity. But yes, just wild to me that someone would still do that in this day and age. But we're coming up against it, Dan. Man, we're having fun. I got to get to my future show in a little bit where we're going to talk about all sorts of horizontal spreads. Before we get there, let's do a couple more, Dan. I'll let you choose where you want to go next.
Oh yeah. Well, okay. Let's do this one. This one, only real old time traders are going to know this. The Raise Bandit.
Who Mr. Schwartz was one. Mr. Flowmaster was one. He is a self-confessed Raise Bandit. He was part of that in the early days.
That's right. That's right.
All those bastards who were picking me off, but he was one of them. I should punch him next time I see him.
And by the way, and what you want to really split here is Raise Bandit is a SIBO term on the East Coast exchanges. They called it something else, and I don't know what their word for raise was, but this is when everything was mostly traded in open outcry on the trading floor.
Here's a test of your day drinking addled brain. Do you remember what RAISE stands for, the acronym?
Retail Automated Execution System.
Yeah, all right. So the day drinking hasn't addled it fully yet, sir.
Yeah. So when it was all open outcry and floor trading, the first electronic trading was RAISE, the Retail Automated Execution System. Again, that's what we call it on the SIBO. It's something else on the East Coast. But what it was is the locals in the pit, in the crowd, the trading crowd, would kind of collectively get together and say, well, okay, I would sell this here, you would sell this here. Okay, so this is going to be our electronically disseminated market, which would go out, and a lot of times people would look up the market but still trade it in the pit, and it would get disseminated via this RAISE, Retail Automated Execution System. And it could only be up to a 20 lot, as I recall. And that's what it was. The first electronic trading. But the raised bandits were guys like Henry,
like freaking Henry,
like freaking Henry, who would like look at the electronic offers from all the different exchanges and be like, oh yeah, this exchange screwed up. They want to sell it lower than this one wants to buy it. So they'd send in 2 orders immediately, like at the same time, and pick off the market makers.
Yeah, Raise, when it first started, Dan, I was still in the, well, not when it first started, but when the multiple listing battle started happening between the, I was still out in the index crowds. But it became so profitable just to have Raise trades. And you're right, they're mostly 10 lots that would come in and out. But they became so profitable early on that every firm was pulling guys out of the indexes, sticking them in the newly emerging equity options crowds just to get on Raise. And then they were taking all their clerks and bumping them up to traders and putting them on a badge, not having them really trade at all, just kind of be in a crowd just to get on Raise, because there was so much money in these 10 lots you were getting all the time. A lot of them were deep delta stuff. And then guys like Henry figured out, wait a minute, there's a 1 lot in the book here of these calls that is now going in the money. I can turn around and ram whatever the max is allowed. I think it was 10, might have been 20, might have been right. 10 or 20 down the throat of the market makers at that price that is now underwater or under parity. And now they have to sell me these, 10 or 20 of these 100 delta options below parity price, and then rush to get their stock to lock in a loser. And then that started happening all the time, Dan. And then next thing you knew, Raise, when you got that Raise ticket handed to you, you just winced. You're like, oh no, what did I do? And you looked at it, you're like, oh yeah, Henry just ripped me off for, a 10 lot of some 1,000 deltas here or there. Thanks, Henry. Good times, but we're coming up against this. I want to pay off our poll here really quickly. We got a lot more, Dan. I think we definitely have to do an episode 2 of this, maybe even an episode 3. What do you think?
Yeah, I mean, holy cow, we sure can do at least one other episode for sure.
I love it. We've been doing the show for 12, 13 years. There's still a lot of new material, or in this case, old material, to be mined as we head on into a real quick mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, let's get to it, Dan. What do you think the results are so far for our ratio spread versus back spread live poll? This is live right now. If you're listening live, you can vote. If you follow us at Options, you should see it. It'll probably be done by the time you hear it on demand, listeners. But Dan, what do you think is winning?
Probably ratio spread.
You would be correct, sir. Your archaic nonsense of back spread, no one wants it. Only 14.3%. They say, take your back spreads and front spreads and shove them, Mr. P. 85.7% going my way. The clearly decipherable ratio spread. So there you go, Dan. Take that for your antiquated terminology out here. And we have another one that actually was inspired by you and by this show, Dan. That's actually our actual question of the week right now. As you recall on the show last week, we were joking about trying to use your Bitcoin during the apocalypse. So it inspired us to say, what is the best apocalypse asset? So we gave you a lot of your traditional hard assets, so your gold or your precious metals, or your diamonds or precious stones. You can carry that on you as well. Or Bitcoin, which was the genesis of the debate. Or then we threw in for fun, Dan, the ultimate hard asset in the apocalypse, which is bullets. And what do you think is winning right now, Dan?
I'm going bullets, canned goods, and gold in that order.
We had one of our listeners point out the other day that if you shop with bullets, it's always 100% discount. And I was thinking that's a good point. Apocalypse or not, bullets can come in handy. 59.1%, Dan, going for the bullet route. 29.5% going for gold or precious metals. Only 9.1% going for Bitcoin, Dan. So Bitcoin, in spite of all the hodlers saying this is the great end of the world asset, not so much when it comes right down to it, Dan. And then only 2.3% for diamonds or precious stones. No love for that, Dan. I guess the lab-grown diamonds are killing that market out there. So interesting stuff out there, listeners. on our mail call for this week. All right, Dan, we had a lot of fun on the forgotten terminology. I got to get into my next show. It's almost about to start. But before we go, Mr. Dan, if folks want to reach out to you and say, Dan, why are you saying things like horizontal spread and front spread so often at MTM? Where should they go? What should they do?
Oh, gosh. Yeah, sure. Make your way on over to markettaker.com. 2 T's in a row. And yeah, I'll love to chat with you anytime.
Hit them up. Say, why do you say front spread and back spread still? Archaic terms. How dare you? MTM, the place to go. Don't forget the second T for Theta. That's going to do it for us on OBC. Not going to do it for us on the network, though. Yet another reason you should be subscribed to the full network, listeners. I'll be joined in a few minutes by our good buddy, Miss Carly Garner, to talk all things lighting up the Futures tape on the Futures Rundown. Stay tuned for that. You don't want to miss it. And then, of course, if you're heading over to the Pro, things you don't want to miss, I would definitely put the one and only Volatility Deathmatch in a class, a category unto itself. If you are even remotely intrigued by all things Vol, and they went hard and deep, and dare I say it, angry, body blows, some blood was shed, tears were shed, a good time was had by all. You got to check out the Volatility Deathmatch. The optionsinsider.com/pro is the place to go to learn more. Then we're back again with our usual array of content, including Thursday, coming back with that infamous Raise Bandit known as the Flow Master. I got to give him a hard time tomorrow. And then we're back again next week. Another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.